Okay, let's get back to helping Taylor out right now. So we finished his 24 tax return. We told him to contribute to a Roth IRA. Now he's asking, okay, what can I do for 2025? And we're starting the year early. We're starting giving advice earlier than not just waiting to prepare the tax return, but way earlier. So what we could tell Taylor is contribute to a 401k plan, and that has the same notion as IRA. There's a traditional and there's a Roth. And we have to be able to explain to Taylor, why are we doing a 401k plan instead of an IRA like he did the year before? Okay. So we're going to talk about the types of 401ks that clients could have. We'll talk about how to calculate the tax savings and how it looks on the W-2. Okay. So there's two types, traditional 401k and Roth 401k. And it's this very exact same concept as what we covered on with the IRA. The only difference is that this is 401k. Now 401k is provided by the employer, okay? The company provides it to their employees, okay? So not all companies offer it. So if a company is big enough and offers it, then they could give this 401k to the employees. Okay, so we talked about this already. Pretty much get tax deduction now, pay taxes later when it comes to a traditional 401k. And then for Roth is no tax deduction now, but no taxes later. Okay, so first thing we want to talk about is employee has an annual maximum allowed combined. Okay, so the maximum allowed is for this year is $23,500. That's for 2024, I believe. Yeah. So it's $23,500 that employees can contribute into a 401k. And as you can see, this is way higher than the $7,000 that the IRA allows, right? So this is why if any client has an opportunity to put into a 401k, this is where you want them to do it because it's a way higher limit, a way higher amount that you could deduct off of your taxes. And the next thing I want to talk about is employer matching. And employer matching is essentially free money. It's literally free money to the employees. And the reason why it's free money is because the employer, the boss, is going to say, if you put into your 401k, I'll put in the same amount you put in as well, up to a certain amount. Okay? So it's literally just the company giving money over to the employees to fund their retirement even further. Okay? So it's possible that an employee could put in $10,000 and then the employer will say, okay, I'll give you an extra $2,000 because I'll match 20% of your salary or something like that, right? So that if the employee never put money in, then the employer doesn't have to match. Okay? So this is why it's very important that when clients have the opportunity to not only participate in a 401k, but if the employer offers a matching, because not all employers offers matching. This is a very special benefit that usually big companies offer to their employees. If the employer offers matching, they definitely want to participate in their 401k because it's essentially free money that they're getting from their employer. Now, let's talk about matching because it's really important that we are able to explain to Taylor why matching is important and why he needs to take advantage of it. Now, there's something called dollar for dollar match and there's something called partial match. So dollar for dollar match is more straightforward. This is a lot easier to understand. The employer says, I'll match 100% of the employee's contributions up to a certain percentage of their employee's salary, while partial match is the employer matches a percentage of the employee's contributions, such as 50% of the contributions, up to a certain percentage of the employee's salary. So this is super confusing when you read it. This is a little bit easier to understand, but we're going to go through the details of each one and use actual examples to help make it clear of what this means. Okay, so for dollar to dollar match, we're talking about dollar. This is the easier one to understand. So the explanation is the employer matches 100% of the employee's contributions up to a certain percentage of the employee's salary. So in this scenario, an employer offers a dollar for dollar match up to 5% of the employee's salary, okay? So this is the employer, the boss comes in and says, hey, for your 401k, I'll match 5% of your salary. But what does this mean? So the employee will say, okay, how about if I contribute 10% of my salary? So this employee makes $60,000, and they're going to put 10% into the employee salary. I mean, how much is 10%? 6,000. Perfect. Okay. So this employee is going to put 6,000 into her 401k, right? And then the employer, because he's matching 5% of the salary, so 5% of $60,000 is $3,000. So that means the employer is going to put $3,000 into her 401k account for free, literally for free. So she got an extra $3,000 just by putting, and this $6,000 is her money. It's going to her anyways, right? So all she's doing is putting to her 401k to save up to be used later, and then her employer just gives another $3,000 on top of that. So now she has $9,000 in her retirement account that she could use later on in the future. Okay, that type of return that you get as an employee is very beneficial. It's a very beneficial plan to be a part of if they're fortunate enough to work at a company that offers something like this. And usually companies that offer this is going to be like really big companies like Google, Apple, Facebook. Let's go through this other scenario where the boss still offers 5% of your salary, but this time maybe she doesn't want to put so much into her 401k because she wants to have more cash on hand because she has higher living expenses. Okay, so she say, okay, I'm only going to put 3% of my salary towards 401k. Salary is still the same, $60,000. So what's 3% of $60,000? 1,800? 800? Okay. So she's going to put 1,800 into her 401k. Perfect. Now, remember the employer says, I'm matching 5% of your salaries. However, because she's only putting $1,800 in, the employer will only put up to $1,800 in as well. So that's the problem, is that if she doesn't put enough in it, the employer is not going to give. So the employer technically could give up to $3,000. But remember, it's a matching. So matching means that if you put it in, I'll put it in and help you out as well. But if you're not putting in enough, I'm not going to put in more than you, right? So that's why the employer is only going to put in $1,800, because she's only putting into $1,800. Okay, so this is where we want to advise clients. Like, we want to make sure to try to get this $3,000 out of the employer. Okay, we want to get all this money out, free money from your employer, as much as possible. So every single year, this is not just a once a year, once a lifetime thing. Every single year, she could try to get up to this $3,000 of free money just given to her every single year, just for working at the company and putting into her own retirement account. Okay, now let's talk about partial match. This is way more complicated because there's a lot of nuances and a lot of percentages that we have to deal with. Okay, so let's just go through the definition real quick. The employer matches a percentage of the employee's contribution, such as 50% of the contribution up to a certain percentage of the employee's salary. So we're talking about two different percentages now that we have to calculate. Okay, an employer offers 50% match up to 6% of the employee's salaries. So here, the employer comes in and says, hey, for your 401k, I'm going to match 50% of your contributions up to 5% of your salary. So now we're going to have to do a little bit of math here. So let's just say she wants to contribute 10% of her salary, same salary, $60,000. So we know that her contribution that she's going to put in for herself is $6,000. Now the employer match 50% of the contributions of 5% of her salary. 5% of her salary is a $3,000. That's the max that they're going to put in. 50% of the $3,000 that if they were to cover 5% of her salary, they're only giving 50% of that. Okay, so that's a company match of $1,500. Okay, so a little bit more confusing, very hard to explain to a client. Very hard to explain to a client. So hopefully, by providing an example like this, makes it a little easier. So let's do an exercise. Okay, for question 1, what's the employee's contribution to 401k? Perfect, 5,000. Okay, for question 2, what's the employer's contributions to 401k? Yes?
Should be 5,000 if it's matching.
And then what is question number 3?
1,000.
Yes or no?
Yes.
Yes? Okay. Hopefully this explains at least the matching portion and how important it is. Like for this client, she lost out on how much? Is it $1,000? $1,000, right?
Yes.
Yeah, so she lost out on $1,000, and let's say she does this every single year. Every year she's gonna lose out on $1,000 that she could potentially have. So she works for a company for 20 years, that's $20,000 that she missed out on. Okay, so let's talk about contribution limits. And for 401k, like we explained, you can put way more money into a 401k than to a traditional IRA or to IRA, right? And there's two things that you have to know based off of age. Anything under age 49 and anything 59 and older. So for 49 and younger, for 2020, oh, it looks like 2025, you could put in 23,500. And this number changes every single year, okay? So I think 2024 was then 23,000 flat, right? So now in 2025, you could put in an extra $500 compared to the year before. So every year it's gonna increase a little bit. Now, if you're age 50 and older, the IRS says we'll allow you something called a catch-up contribution, which is $7,500 on top of this one right here. So your total here is going to be $31,000 if you're old, age 50 or older. And this is just a way for IRS to promote maybe those who didn't fund their retirement early on enough, but they're concerned about retirement as they get older. So then this gives them a chance to put more towards their retirement as a safety net. Okay, so let's calculate the benefit of a 401k. So let's just say their total income, taxable income, is $100,000 from wages. And I'm just going to use flat numbers, not using the tax bracket numbers. Let's just say they're 25% bracket. Okay, now if they owe 25% on $100,000, that's $25,000 of taxes that they owe, okay? And they're paying taxes on the full $100,000 of income. Now, let's just say if a client puts in $20,000 into their 401k, so this on the left side is they're paying the tax on the full amount. On the right side, $20,000 is going to 401k. And remember, we're bringing down the taxable income as much as possible. So now their taxable income is only $80,000. Times that by 25%, their tax is only $20,000 compared to $25,000. So this is where contributing into a 401k consistently, they're saving, in this case, $5,000 every single year. And remember, it's every single year that they're saving. It's not just once in a lifetime. It's not $5,000 once. It's every single year. So this is why we want to promote this to clients, because they do it once, most likely they're going to do it again next year. They're going to do it again the year after. So we want to make sure that clients understand that this isn't a one-time thing, that we say, hey, if you do this now, you're going to probably continue doing it the year after, and you're saving $5,000 every single year based off this one recommendation that I gave to you now. Now let's talk about what happens in future years when we put the money in. So the client, let's just say the client only puts in $20,000 for 1 year, okay? And after that, maybe they stop working, they don't put in any money, they forget about it. And that $20,000 over the years is going to increase in value because of investment, right? There's going to be interest, there's going to be earnings, capital gains in there. And as this account grows every single year, it's not taxable. So even though from year 1 to year 2, it went up $1,400, because it's inside a 401k account, it's not taxable. It just keeps on growing. So every single year, they don't pay taxes on this earnings or growth at all. Okay, so it just keeps on growing and keeps on growing. And then let's say over time, now he's in year 30, he's gonna retire. That $20,000 is now worth $150,000. Okay, that's inside of his account right now, just based off his initial investment of $20,000 when he first started. Over time, compound interest, now it's at $150,000. Okay, so now he's ready to take out this money. So he has $150,000 in this account, and let's just say he wants to take out $30,000, which is this the red and the light green portion right here. That represents $30,000 he's going to take out. The red is a tax is what he owes. Okay, so out of $30,000 he takes out, $1,500 is going to go to taxes. That means he's only left with $28,500 that he gets to use for the year. Okay, so this is where every time he takes money out, he's going to pay a little bit of taxes. In this case, he's in the 5% bracket. So he is in a lower bracket. Before, when he was putting the money in, he was in a 25% bracket. Now he's in a 5% bracket. But just know, every time he takes money out every single year, he's just lowering down the balance, but he's paying taxes every single time he is taking the money out, right? So it's $1,500 here, $1,500 there. So do you remember how much he saved originally just by putting that $20,000 in? $5,000, right? He saved $5,000 when he first put that money in, but now he's going to be paying $1,500 in taxes every single year. How many years in taxes will he be paying to reach $5,000 in the tax savings that he got already? This is probably like 3 years? No, 4 years. 4 years, right? So in 4 years, and then if he continues taking more money out after those 4 years, doesn't it sound like he's paying more taxes now? Because he only got a $5,000 tax savings originally, but now he's retiring, he's paying $1,500 every single year for part of the next 10 years. That's $15,000 in taxes that he's going to be paying, right? So this is a situation where a traditional 401k might sound good at the beginning, but really when you think about it over time, it might not be the best for the client. Okay? So this is where let's talk about the Roth 401k. Same situation, $100,000 income, 25% bracket, they're going to owe $25,000 in taxes. Okay, and they put $20,000 into a Roth 401k, but here's the difference, is that it doesn't change anything. They're still going to pay $25,000 in taxes. So no tax savings whatsoever. Same situation, account's going to keep on growing. So let's just say they put in that $20,000 once into a Roth 401k, and the account keeps on growing and growing and growing. Now it's worth $150,000, and he's ready to take all the money out in year 31. Or take $30,000 out. So he's taking $30,000 out right now, but no taxes, right? So he gets a full $30,000 in his pocket and doesn't pay any taxes whatsoever. So he could just keep on taking $30,000 every single year and not pay any taxes whatsoever, okay? So this is the benefit of why a Roth account is so powerful. And more financial advisors are gearing towards and leaning towards advising pretty much almost all clients to go to a Roth account. Because most clients, they want to fund their retirement account. It's just which account do we choose? And I'm leaning more towards Roth, okay? And that's what I've been telling clients. And some clients will say, hey, well, I'm not getting any tax savings. Like, why should I do this? And this is what you have to explain. And it requires a lot of detailed explanation for the client to fully understand why they're doing this. Because for most US clients, they want instant gratification. They want to get the tax savings now. But we need to be able to explain, hey, sometimes that's not the best way. We need to maybe think about a Roth and think about the future. Tax deduction now, pay taxes later, no tax benefits now, and no taxes later. So I keep on reiterating all these things. You're going to hear me repeat a lot of these things over and over again because from what I learned with training a lot of people over the years is that it takes a person to hear it 7 times before they hear it the first time. Okay. So we definitely need to re-say a lot of these things over and over again. That's what you're going to hear a lot throughout this whole training workshop is that we're going to repeat a lot of things over and over again because I want to make sure that it's ingrained in your head and at least you get to retain it. Because if I just said it once and said, okay, I expect you to remember it, that's not realistic. Okay, we're going to re-say it over and over again. Okay, now let's get into the complicated part. How does it look on the W-2? The W-2 is the official document that all employer gives to their employees. This is what you report on the tax return. It shows your total income. It shows your total withholdings. So this is a W-2. This is what a W-2 looks like. There's a lot of numbers on here. There's a lot of boxes. And trying to figure out how 401k affects these numbers is a whole ordeal in itself, okay? So hopefully you guys can see it. In this case, the wage here is $539,000. The withholding right here, box 2, is $115,000. How does box 1 get affected by 401k contributions? So actually, I should ask, where does it show the 401k contributions here? Does anyone know? What is that? Box 12, yes. Which one? So there's box 12A, B, C, and D. This one, right? So 20,500. Okay. So code D right here. So box 12 is just different information. And then each code, like CD and DD, represents something that either the company paid for or the employer, the employee paid for. For D always means 401k, traditional 401k. Okay, so this client right here put in $20,500 into their traditional 401k. Now, how does box 1 get affected? So you see that the client here has $539,000 in taxable income here. Does this include the 401k or not include the 401k? Does it deduct it yet? Yes or no? Yes. So it deducts it already, right? And the way you know it deducted already, if you look at this Medicare wages, box 5 right here. So for Medicare, no matter what your income is and whatever deductions you have through your employer, they're always going to charge Medicare tax. So Medicare doesn't account for any deductions. So in reality, the client actually made this much, $559,000. That's in reality. But because they made a $20,500 contribution, it reduces box 1 by that amount. So this minus $20,500 should equal to that. Okay? So box 1 already takes out the 401k contributions. So when we report this, we don't need to re-report the 401k contributions anywhere else. It's already shown right here, and then we could prove it by showing it with code D right here. Okay? Box 1 already reduces 401k, so I already talked about that. Box 2 is code D, so we confirmed that. And then 401k does not reduce taxes. Okay, so these two boxes, Social Security and Medicare, 401k doesn't reduce any of that. Okay, so earlier when I talked about Social Security tax, there's a maximum. For year 2022 is $147,000. So meaning that once your salary reaches $147,000, anything above that doesn't get taxed for Social Security anymore. Okay, so that's why it shows a maximum of $147,000, and this is the maximum Social Security anyone should pay in that year. Payroll and W-2 are subject to 3 different taxes. So we talked about this earlier. I want to make sure that we understand that this is the federal withholding that they take out of every single paycheck. So when a person receives a paycheck, a certain amount goes to the IRS automatically. Okay? Social Security and Medicare, this is automatic. This is that flat percentage that we talked about, and we can't really change that. Okay? And on the tax return or in the tax program, I want to always reiterate that we have to make sure that these numbers are inputted correctly, because if you are off on these numbers, it messes with the calculation for Social Security credits, and that's something we can't have. And that's a whole nother discussion for later. But knowing that, because in a lot of the US tax programs, when you enter this amount here, it automatically transfers it the same amount to this box when you do the data entry. So you have to be careful that we increase this box by the 20,500, okay? Because we don't want this calculation to be off at all. Okay, we want to make sure that the government knows that, hey, this client paid more into Medicare, so we have to make sure that we report it correctly. Because if we match it with the box 1, then that means this number is going to be lower on the tax program too, and we don't want clients to, because you're supposed to pay into Medicare, and that's how you get credits for the future if you need it when you're older. So this is important to have. Okay, so now let's go into a Roth 401k. So slightly different. This is a W-2 for a client that works at Google who has a Roth 401k. Now, you remember with Roth 401k, you don't get any reductions in income, right? So that's why you'll see box 1 actually matches with box 5 here. Because remember, Medicare tax is going to tax the full amount. And then because you don't get a deduction, it's pretty much going to be the same as box 1. Now, does anyone know where does this show that he contributed into a Roth 401k? AA, perfect. Yes, AA is the code for Roth 401k. So when you see that, the code AA, you know the client put into a Roth 401k. Okay. So we talked about how box 1 gets affected. It doesn't affect anything, nothing changes. Where does it show in the W-2? It's AA. And how does it affect Social Security Medicare tax? It doesn't affect it whatsoever. Okay. Now, is it possible to over contribute? So if in that year the maximum was $20,500, what happens if someone puts in $21,000 by accident or $22,000 by accident? Is it possible? And what happens if that does happen? Okay. So in most cases, over contribution only happens when they switch jobs. Okay? Because if they work at job A and let's say they max it out at $20,500, then they move over to job B, and then job B, they don't know if they did any contributions. So what if the employee just accidentally says, yeah, I want to continue contributing to 401k. They don't know anything about maximums. So they just contribute through the new employer as well, right? So that's usually where the case of seeing over contribution happens, is if they switch jobs. Okay? It's not only just switching jobs, but sometimes if they're working at 2 different companies at the same time, that could also affect it. Okay? So as long as there's 2 jobs in the same year, that's when you usually see this over contribution. And if a client actually over contributes, it's something that we need to fix right away, because it's not good to keep it over contributions. And I'm going to explain why. Okay. So in this case right here, the client, say this is the wife, is over 50 years of age, and the contribution limit for 2022 was $27,000. So in job 1, she contributed, how much is that? $23,200. And in job 2, she contributed $4,306, right? So what's the total for that? What's 23,200 plus 4,306? 27,506?
Yes.
506. Okay. So if the maximum is 27,000, that means they over contributed by $506, right? So what happens? What happens when they over contribute that little, even if it's a little amount? But what should we do when a client does over contribute? We normally won't see this until we actually file the tax return. So in this situation, let's say we're filing a tax return, we see they worked at 2 different jobs, and we see that they over contributed by $506. What do we tell the clients? Okay, we're filing a tax return. It's before April 15th, before the deadline. We need to tell the client something about this over contribution. We can't just leave it in there, because if you leave it in there, it's actually considered taxed twice. Because this $506 is automatically, the program will automatically add it back to income, because the program says, hey, you're over, the limit's $27,000, but you're over $506. It's going to automatically apply $506 to the total income, automatically, okay? And that's taxed once, because now it's added to income. And it's going to be taxed twice, because later on when they retire and to take that $506 out, it's taxable again, okay? So that's why it's going to be double taxed if we leave it in there. Hey, you can't take this money out, this $506 out, but you have to do it by April 15th of the year, whatever year you're filing, after the year you're filing for, okay? So if we're working on, say, 2022 taxes, then we have to let them know that they have to take this money out by April of 2023, okay? And they could take it out. They're already paying taxes because remember, the program automatically adds it to their total income, but at least they could take it out and use it and not pay taxes again later on if they were to just leave it in there. Okay? So super important that we tell the client that if they over contribute, they have to take this money out by April 15th. So we know there's 2 types of 401k, traditional, Roth, but a lot of clients might be confused as that they feel like they have to do either one or the other. They feel like, okay, I have to either do traditional or I have to put all my money into a Roth 401k. But that's actually not the case. You could actually split the contributions up between the 2. So if the contribution limit is $23,000, you could do half in traditional and half in Roth. And this is a good way if they want to, I call it hedge your bet, meaning that you don't really know where things are going to go, and you kind of just want to spread it around, get the benefit, get a little benefit now, but also get a little benefit later with the Roth, right? So it's a great way to let clients know you could do both, and it could be 25% here, 75% here, 10% here, 90% here, whatever you want. But definitely letting clients know that, hey, you have the option to do both. And that actually might be the best option for a lot of clients because we really don't know what's going to happen 30, 40 years from now about taxes. It's speculated, it might go up, but we really don't know, right? So it might be good to get a little bit of tax benefit now and then also know that we have some tax benefit in the future. Okay, so for traditional IRA, in general, this is the general rule right here, is that if the client is in a higher tax bracket now and knows they will be in a lower tax bracket later, and if they want to have short-term savings goals, like they want to save taxes now, like let's just say that if they put into a traditional 401k, they know they're going to get tax savings now. Let's say they save $2,000 in taxes. So that means they want to take that $2,000 and save it for something else, okay? So it's really short-term saving. It's not very common. Most of the common excuse is this one right here, is because they feel like they're going to be in a high tax bracket now and they're going to be a low tax bracket later. Okay? So here's an example. Linda is currently in a high income tax bracket and wants to reduce her taxable income. She expects to be in a lower tax bracket during retirement and wants to take advantage of the upfront tax savings. So what she's going to do is right here, as she's working, she's younger. She puts into her traditional 401k, and the tax savings she gets from that, maybe she saves $3,000 a year just by putting into her 401k. She takes that $3,000 and she invested in something else. That's usually the idea of why you want to get the tax savings, taking that money that you're saving from taxes and putting into another investment. Now, here's another example. Mark is saving for a down payment on a house in the next few years, and he wants to maximize his take-home pay and lower his taxable income to save more money for his short-term goal. So in this case, he contributes to his 401k. He knows he gets a tax savings $2,000 every year. So let's just say he files his tax return, he gets a refund of $2,000 every year because he contributed to his 401k. So he takes that refund and he just saves it because he wants to save for a down payment on the house. Okay? So in 5 years, he saves $10,000. He could use that as a down payment on the house. Okay. Now, let's talk about a Roth 401k. Again, reiterating everything again. You anticipate to be in a higher tax bracket during retirement. You're in a low tax bracket now. You're young in age now because you want longer time for tax-free growth. Okay? We want to make sure that anyone that's young is going to do a Roth 401k no matter what. So this example, Emily and Brad are in a relatively low tax bracket and expects both of their income to grow substantially into the future. They both choose a Roth 401k to pay taxes now and enjoy tax-free withdrawal during retirement when their tax rate is likely higher. Okay, so that's in it, kind of like a little story if you needed to share with clients on why you would do a Roth 401k. Another example is James is 22 and just started his career. He chooses a Roth 401k to get the benefit of tax-free growth on his long-term investments. Remember, he's only 22. He's going to retire probably at, say, 70, right? That's 68 years of tax-free growth that he's going to get. And the general rule when it comes to investment is that every 10 years your money doubles. That's the general rule. Okay? So if it's 50 years of growth, so every 10 years it's going to double, that's a lot of doubling that's going to happen. Okay? And every time it doubles, none of it's going to be taxable. So when he takes his money out, none of it's going to be taxable. Okay? So of course, we talked about this. You could put into both. You want to hedge your bet in a way and do a little bit on the traditional, do a little bit on the Roth as well. That's possible. And 50% is a standard. When I talk to clients, I tell them, well, you could do half and half because it's easy to understand, right? And the benefit here is that they could do 50-50 this year, and then maybe they change their mind next year. They want to do 25-75, right? And then next year they want to change it again. So they're not stuck with this 50-50 once they make that choice, right? There might be a year where when they first started working, they're doing 100% Roth, right, for 2 or 3 years. And then now their income's way higher. They're like, okay, now I want to do maybe 2 years worth of traditional just to get tax savings now. And then later on they switch maybe half and half. Okay? So very common scenario, but something that the client should be looking at every single year of what their allocation is. Okay, so in this case, for doing a little bit of both, Ken is 45 years old. He's healthy and looking forward to working for many more years. Like everyone else, he doesn't know what taxes will look like in 25 years. He doesn't want to put all his money into one plan because he wants to get the benefit of both sides. So he decides to put 70% in Roth and 30% in traditional. Okay? So repeating myself again, traditional 401k. If you're in a higher tax bracket now and you expect to be in a lower tax bracket later, and then for a Roth 401k, if you anticipate on being in a high tax bracket in the future and you know you're in a low bracket now or you're young and you want a longer time for tax-free growth. Things that we've talked about that I want to repeat is for if you're advising clients on 401k, we need to know these three things. First, we need to know employer matching, which we discussed. Right? Very important, take advantage of employer matching. We always want to take advantage of employer matching. Withdrawal age and penalties, we have to make sure client understands, okay, at what age can they start taking this money out? And at what age that if they do take the money out, that they're subject to taxes and penalties versus not being subject to anything, right? And then we need to let clients know that for traditional 401ks, once you reach a certain age, you have to take this money out slowly, okay? And there's a whole calculation on how much money to take out. It's based off your age, it's based off the balance of the account. So, and usually the brokerage will do the calculation for the client, but the client does have to know that they are required to take this money out, okay? So employer matching, not all companies offer it. If they do offer it, we want to make sure that they do it with withdrawals, age, and penalties. If any funds are withdrawn from a traditional 401k before the age of 59 and a half, there's a 10% penalty and tax. So what we talked about, this is a last case scenario for most clients. Like if clients, there has to be in a bad situation where they need to take this money out, they have no other resources to get the money. I always tell clients, get a loan somewhere else, credit cards, because if you're looking at a 10% penalty and if they're in, say, the 30% bracket, that's 40% automatically. And if they live in a state like California, if that's an extra 10% state income tax, that's 50% just going to the government. So you worked so hard to put all this money inside this account. Say you put in $50,000, all of a sudden you need to take that $50,000 out. $25,000 is going to go to the government. Like, does that sound good? Right? So I always tell, that's what I tell clients, like 50% is going to go to the government. And usually when they hear that, then they're like, okay, let me try to figure something out. But there will be situations where they're still very desperate, they need it, then they'll go through that route. But they have to understand 50% could be going to the government. Okay. Next one is RMD. This is 73 is when the person starts needing taking this money out. Now, things to know about Roth. Employer matching. So if a client puts into a Roth account, the employer could still match. Now, the difference is that the portion that the employee puts in, like the client puts in, that's not going to be taxable when they retire. But the portion that the employer matches, that's going to be taxable. Okay? So understanding that with employer matching, technically when the employer matches for the employee, they got a tax deduction for it. Because the company got a tax deduction for it, the IRS is going to want to see, okay, who's going to pay taxes on it later, right? So general rule of taxes is that if someone gets a deduction, someone else is paying taxes. That's the general rule, okay? For withdrawal, age, and penalties is that withdrawals are tax-free as long as from the principal. So the principal means that the money that the employee contributes originally, not the matching, but the money that they put in themselves, then they could take that money out and there's no taxes, right? The only time it's taxes is once they withdraw all their original principal and they're taking from the earnings now. That's when it's going to be taxes and penalties. And then another thing we have to know is the 5-year rule. So to avoid a penalty, the IRS wants to make sure that you had an account for at least 5 years. If you don't have the account if you only had an account for 3 years, then and you take the money out, then there could be some penalties. Okay, so make sure that the client knows that there's a 5-year rule, because this prevents people from moving a lot of money into a Roth and then trying to take the money out a year later and expect no taxes. Okay, and an RMD, a great thing about Roth is that you're not required to take it out. You can leave it in there to keep on growing for as long as you want. Okay, so super important that client understands that this could just be left in there and could just be given to their kids or whoever is inheriting that account. So if they don't need the money, they just leave it in there. Let it continue growing tax-free. Okay, so I have a question. If a client makes $150,000, contributed $15,000 to a Roth 401k, what is the taxable amount?
150.
150. Perfect. Yes. Still $150,000. Now, if the same client retires at age 62, would the client have to pay taxes on the withdrawal?
No.
No, right?
No.
No. Perfect. Because it's a Roth account. Remember, whenever they, at the age of retirement, they take that money out, none of it is going to be taxable. Okay. Next question. If a client makes $150,000, contributes $15,000 to a traditional 401k, what is the taxable amount?
135.
135?
Yeah.
Perfect. Good, good. And if the same client retires at the age of 52, would a client have to pay taxes on the withdrawal?
Yes.
Yes. Okay. Because he got a tax saving here, that means he's going to owe taxes here. Okay. Okay. So multiple choice. Amanda just started working at a new company. They offered her two types of retirement plans, traditional 401k and Roth 401k. She wants to contribute, but wants to know her options. Oh, this isn't a choice. This is actually the options. So she could either contribute only to traditional 401k. She could have the option to contribute only to a Roth 401k, or she could contribute to both. Okay, so these are kind of like the general guidelines. It's not set in stone, it's not facts. Make sure these are just general guidelines to follow for clients to know. When should they only contribute to a certain plan or when they should do both, right? So if they want to contribute only to a traditional 401k, these are usually only for older people in higher tax bracket, and they want to get the tax savings when they're in a higher tax bracket. They should only contribute to a Roth 401k if they are younger, like I've been saying over and over again. They don't really need any deductions because their tax bracket is really low. And it's more beneficial to not pay taxes on the tax-free earnings in the future. Okay? And they want to contribute to both. And usually it's usually if they're in the middle of their career where they're kind of in between like high, low brackets in the middle, it might be a good way to do to contribute to both. Okay? So besides 401k, what else can we do? Okay, so remember, we're recommending this to the client early on in the year, right? Where, let's just say we're in January, February time frame. No, March, April. Let's say we're in May time frame, in the middle of the year. We already let clients know, okay, max out your 401k, get the matching. What else can we advise to clients?